Today I'm going to cover the direction of the stock market. I'm going to look at what Mike Wilson says from Morgan Stanley, couple that together with Adam Parker from Travariat. Very similar views. I'll play both of those clips for you. Their current view today of what is going to happen for the rest of this year and into 2024. Mike Wilson has been extremely accurate in his predictions in the past, so I think you'll find this helpful. And then finally, we'll take a look at Mohamed El-Erian's view of inflation, the Fed's response to inflation, and the impact on the economy and the market. Again, another very helpful view of what's going to be happening with the stock market the rest of this year and into next year. Hi, I'm Ben Reppond. Excuse me. Welcome to my YouTube broadcast. Today is April 18, 2023. I'll begin with Mike Wilson. I began playing Mike Wilson back in December. I think it was December 13th. I played a clip, and he gives a very specific prediction on where the S&P will be and when it will be there. That's very hard to do, but he's been quite accurate. Not perfect, but I mean approximately correct. And he is viewed on Wall Street as probably the best research firm with data, predictions, etc., that among everyone. But and I think he's right on his prediction, but he's off on his time frame. And he very quickly and correctly admits, he said, I made a mistake on this. But he's holding with his prediction. So I think you'll find that interesting. And he says, I'm going to convert this to percentages for you because the numbers may not make sense. So he's looking at the S&P 500. And he's saying as he's looking out from here, mid-April, he's looking out and saying the base case, BASE, the probable scenario, they call it base case, is down. The S&P will go down this year about another 6%. So not much. A correction, but not something that's going to shake most people. The best case scenario is that the S&P would be at, I think he says 4,200. In other words, up about 1%, a little over 1% from here, best case. So don't be looking for much, don't have much of an optimistic view that the market's going to go up much from here this year if you believe Mike Wilson. He's taking his data from the companies that they call who are part of the S&P 500 and saying, what do you expect your earnings to be for this next year? And then they're extrapolating from that into stock price. They build it into a computer model. And again, it's been pretty accurate. The worst case this year is down 13%. Not a collapse, but it's 13%. That's worst case. As he looks out into next year, looking beyond 2023, and I believe this is 2024, he didn't really put a time frame on it. He just said ultimately the market is going to be going down into the S&P, down into the low 3,000s, probably around 3,200. I think he even gives himself a range of 3,000 to 3,300. So if you just said down around 20 to 25% or 23% from here, now we're already down some from the peak, but 23% more down from here, ultimately, let's say that's 2024, could be 2025, we don't know. But that is his estimate based on the research that they have from the companies that they follow. And I think this is a fairly accurate view, both on time frame as well as numbers. So people always want to know, where do you think the market's going to go? That's a pretty good answer. So I'll play this clip from Mike Wilson. So I don't want to take away from what he says because he says it very well. I just wanted to put some percentages to it because when he gives these numbers, it may not make sense. So take a listen to Mike Wilson.
Have you revised upward your target for the S&P, where, say, the 3,200 bear case isn't really at play anymore?
Well, look, the way we look at the world and the markets is we have a sort of a 12-month view, and then we have a shorter-term kind of tactical view. And on the sort of year-end target prices, we haven't budged those because we think those are still accurate. 3,900 is our base case for year-end, 4,200 bull case, and then a 3,600 bear case. Those are in place. Okay, those have not changed. The tactical trading path, what we've gotten wrong this year is the timing of it. We don't think the path is necessarily wrong. We put those targets of 3,000 and 3,300 for a trough for this cycle in May of last year. Okay, so that has not changed. But calling the price and the time, I mean, it's hard enough to get one right. To get both right, I think, is tricky. So we've been wrong on the timing for sure, but it doesn't change our view that low end of the range, that path to 3,900, we think still goes through kind of low 3,000s ultimately.
How difficult has it made your job, Mike, to see the volatility in the rates market persist to the same degree that we've seen over the past few months?
Well, I mean, I think rate volatility leads equity volatility. I mean, the rates market, I think, have moved away from the equity market view that the banking stress is going to lead to a credit crunch and probably a situation where the Fed's cutting rates because there's a recession, and the equity market is not priced at all. So, you can place your bets. Who do you want to kind of lean with? We're in the earnings recession camp. So whether we have an economic recession or not, I think, isn't as important as the earnings recession. And we're highly confident now that that's going to happen, that the earnings situation is way worse than what the consensus thinks, which is more in line with what we've been saying all along. And the banking stress only makes us more confident in that view.
I'm following Mike Wilson with a clip that I got this morning off of CNBC, and they are interviewing, or Scott Wapner is interviewing Adam Parker from Travariate. He's the founder of Travariate, which is a research firm. They supply research to Wall Street. And he is echoing, he even says this, I think Scott Wapner picks up on it. He says, it sounds like Mike Wilson. But what he's saying is that the market has probably got going to go down from here, and probably the way he says it, I think he says or implies 2024. Again, I took that to mean pretty similar to Mike Wilson. But again, just from a completely different perspective, a different individual with different research, but it's, again, that gives credibility to Mike Wilson's prediction. So take a listen to Adam Parker.
I mean, the earnings revisions during the first quarter were down in every single sector of the market, down 6-7% from Jan 1 to March 31st. So they're clearing the lower bar, but I wouldn't say, all clear signal earnings are great. I think it'll be mixed, and I think the big investment debate is how much of the Fed action is already in, or has it even started? And all that, what I think is more the case is we had a big sort of reopening and unwind of the reopening, and I think now you're about to see the lagged effect of the Fed action. So I'm in the camp that earnings are going to come lower, probably much lower for 2024 numbers than we have.
Okay, so you're in that Mike Wilson, Morgan Stanley.
I mean,
camp.
He's in my camp, I'd say. Let's phrase it that way.
Okay, I figured you were going to go there. But the bottom line, though, is that you still think, and those who are more cautious still think, that earnings expectations are too optimistic.
Yeah, I do, but I don't know if that always matters, as you know, for whether the stock market goes up, right? So,
well, what do you make of that then?
I mean,
right? Because the market, I think you can also admit, has been pretty darn resilient.
Extremely resilient, and I think there's three reasons for it if you take sort of the growth part that's leading. One is, this perception the Fed got dovish and inflected. You see that in the bond market, you see it in growth equities, right? You see it in semiconductors, et cetera. Mm-hmm. Two is something that I think is probably real, which is AI. The parts of AI that are real, they're going to drive very rapidly some big changes. And so there's real fundamental reasons why NVIDIA is up. It's not all the Fed. And I think the third is sort of the relative defense people perceive about the big FANG M stocks, that basically if the overall estimates are way too high, maybe there's some defensive in there. So some logic why that part's led and outperformed. But I don't think it's an all clear signal that this guy, whatever. I think the earnings will decline. And right now the estimates are $219 or so for 2023, $219, $246 for next year. I think that the better number for next year is probably more like 220 or 225. So you still have some real revisions for 2024 numbers.
From there, Adam Parker and Mike Wilson, I want to shift gears a little bit and play a clip from Mohamed El-Erian. He is incredibly smart, incredibly insightful, and he approaches this really from a little bit more on the economic side. So he's tackling the issue of inflation. Inflation, he says, is going to be sticky at about 4 to 5%. And what he means by sticky, in other words, what the Fed is doing in raising rates in order to push inflation down, hopefully down to their 2% target. What he's saying is he believes that we're going to hit this range of 4 to 5% inflation, and it's not going to want to push down much more. And this is due quite a bit to wages. But the Fed is very committed to getting it down to 2%. So if it's sticky at 4 to 5 and the target is down at 2, then he says the Fed is going to have to raise rates higher and longer. So we may be in for a period, and this comes at it from the economic side, not the earnings side, but we may be in for a period, following his thinking, of many years, several years, of higher than normal inflation. Even if it's 4 to 5%, that's quite a bit higher than normal. 4 to 5% for a more extended period of time. The repercussions of this, the outcome of this, is a crashed economy, and then he says the financial system. And what I interpret from that is the stock market, equities. So again, when you look at what Mike Wilson's comment is, and Adam Parker, as you push out into 2024 and beyond, and putting that together with the view of Mohamed El-Erian, that that is probably where the deeper part of the decline is going to be in the stock market and in the economy. But anyway, that's my thought on it. Take a listen to Mohamed El-Erian.
Joining us right now is Mohamed El-Erian. He is Allianz advisor and president of Queen's College, Cambridge. And Mohamed, first of all, great to see you. Thanks for having me. Joe and I were talking with Andrew earlier this morning just about how it's surprising to see yields that are higher given the weaker than expected inflation data that was out there. That would make you think that the Fed is getting near the end of the rate hikes, and maybe as a result, yields would come back down a little. What happened?
So two things happened. One is core inflation was not weaker than expected at 5.6%, and that's the one to look at. And second, flying under the radar screen are survey measures of inflation. Mm-hmm. You had the New York Fed last week showing that inflation expectations for this year have gone up a full 0.5 percentage point. You had the Wall Street Journal this morning surveying economists. That's up 0.4 percentage points. So what you're getting is recognition that inflation is going to be sticky at around 4 to 5%. And that's what's been reflected in the 2-year that has traded back up to 4.14 and higher expectations of 25 basis points hike at the beginning of May.
You think that it's going to be stickier too?
Oh, absolutely. I mean, I've been saying this for a while, that if you look at how inflation has migrated from a few goods, food and energy, up to the whole goods complex, and now to the service complex, and we're starting to see it in wages. People should follow the Atlanta Fed wage tracker. That's up around 6%. So if you look at what has happened to the inflation dynamics, it's now embedded in the service sector, and it's starting to impact wages. And that's what happens when the Fed is late. That's what has happened in past episode, is that inflation goes from things that are interest rate sensitive to things that are less interest rate sensitive.
Meaning even if they hike rates further, it's not going to have that much impact?
You need to go higher and for longer, and therefore you incur two risks that we've talked about. One is to the real economy, and the other ones to the financial system.
Okay, now I'm going to shift gears. So do you wonder where the money's going? Is the money going into the stock market, coming out, going into money market, or coming out? I'll tell you. From the flow of funds report for this past week, here's where the money's going. Out of equity funds, $9 billion, $9.3 billion. A little bit, $300 million, which relatively speaking is small, going into bond funds. So let's just say that's approximately neutral. 30 billion going into money market. So the market has been up somewhat, generally positive this past week, and positive for the recent period of time, the past several weeks. But money is going out of the stock market. Wow, that's interesting. And 30.3 billion went into money market funds. What that tells you is there is a flight from risk assets and a flight into safe havens like money market. Interesting. Thank you for watching. If you have questions or comments, leave them in the comment section below, and I will try to respond to them. Thank you.